Hey guys, welcome to episode 14.2, and in this episode we are going to go through a dynamic trend combo trade that occurred on the CAD yen. So here we have a very clear dynamic level on the monthly time frame that has acted as both support and resistance. You can also see a very clear head and shoulders pattern, which is a bearish pattern. Price then breaks below the 50 EMA for the first time in about 3 years, because the last time it crossed was about 3 years ago. So this is another bearish signal. Price also breaks through support and makes a lower low. Price then pulls back to retest this broken support as resistance and creates a very perfect long wick candle. Price is also rejecting the 50 EMA as it is acting as dynamic resistance. So now that we have bearish price action on the monthly, we need bearish price action on the weekly. So let's jump down to that. Now on the weekly, you can clearly see that price is telling you the same thing, as it came up and rejected this level of resistance. And you can see this through the long wick candles, which is another bearish bias. But again, there's still no entry. With bearish bias on the monthly, bearish bias on the weekly, we still have to jump down to the daily to pinpoint a bearish entry. So let's jump down to that. So here in the daily is where we confirm the entry. We want to enter a trade short, but we need price action to confirm that this pullback occurring here is over and that the dominant trend will continue down. Remember that just because the monthly is showing bearish price action and the weekly is showing bearish price action, technically the move upwards here on the daily is bullish price action. Now, once it breaks this trend line, it signals to us that the pullback is over, followed by these multiple wicks rejecting the 50 EMA. And this confirms to us that the daily price action is bearish. This is the combo. Monthly bearish, weekly bearish, and then we waited for the daily to also show bearish price action. And we enter right at the break of this pullback. And this trade ended up being a monster. Now, you can target the recent swing low as it is a level of minor support, or you can go for a bit more due to the heavy bearish momentum on the higher time frames. But this is up to you whether you want to be a more aggressive trader or a more conservative trader. We personally always go for more because we are more aggressive in our style. And when we notice heavy presence from the higher time frames, we always go for more. Now, this is up to you. You can target the recent levels or you can go for more. So in terms of risk reward, we risked 1 to make 3, meaning we risk 1% to make 3%. And this always gives us a good leverage over our risk reward model. So thanks for watching, and I'll see you in the next episode.